Hi, the next in line is solvency ratio, and as the name suggests, solvency implies the amount that the company can generate to meet its long-term obligation and will likely to stay in business. That is if the company wants to stay solvent. And yeah, so this is basically the literal term solvency. To stay in business, the company must generate more revenues than debt in the long term. Obviously, suppose you have a bank loan and you are paying interest of 20,000 and the total earnings that you have is only 10,000. Hence, there is a big question on your solvency. Meeting long-term obligation includes the ability to pay any interest incurred on long-term debt. The example that I just gave you. Two main solvency ratios are the debt to equity ratio and times interest earned ratio. Okay, looks very technical. Let's get to it. Okay, now this ratio says that it shows the relationship between debt and equity, that is debt divided by equity. So now you know the formula for sure just with the name. Okay, but why do we have to calculate debt to equity ratio? Because it is less risky and less costly to use equity sources. Okay, therefore a company wants to know how much debt and equity contributes in its financing. Okay, there is my blackboard. Yeah, right here if we have equity and right here if we have debt. So both are our liabilities. Okay, but for equity, what do we have to pay back? That is the dividend. Okay, and profits. Okay, and for debt, what do we have to pay back? We have to pay interest. So which one is more risky? Risky and risky. Which one is more risky? That is interest, because you will always have to pay interest no matter what. But for equity, you can always choose to not pay your dividends, considering your if you don't have the favorable profits. See, that is why a company wants to know how much debt and equity contribute to its financing. Okay, that is how much debt and equity contributes to its capital, or the left side, or the sources of fund side. A company would prefer more equity than debt financing. Okay, obviously would prefer more equity than debt financing. The information needed to compute debt to equity ratio and the current ratio. Okay, so let's write that formula in our worksheet first. Going back to Hallmark ratios and right here fourth. Before writing fourth, we have to write we are on the solvency ratios. Okay, solvency ratios. Fourth is debt to equity ratio. Okay, the formula is debts upon equity. You want to write an extensive formula, you can go ahead. Total liabilities upon total equity, stockholders equity. Okay, stockholders equity. Okay, let's apply this formatting here. Yups, looks good. How much is the amount of total liabilities of Hallmark? Total liabilities is 1,50,000. Okay, equal 1,50,000 divided by stockholders equity is, where are you, 2,50,000. Okay, 2,50,000. Formatting same. Yeah, let's divide it and let's calculate. Equal to 15,000,040 divided by 254 times 0. Enter 0.6. Let's check the answer. Okay, what? Looks like we entered something wrong. That is equity. Okay, the total stockholders equity is only 1 lakh. Oops, one, yeah. So the amount will come to 1.5 or 1.5 is to 1. And what's the analysis? This means that for every $1 of equity contributed towards financing, 1.50 is contributed from lenders. This would be a concern for Hallmark. This could be a red flag for potential investors that the company could be trending towards insolvency. Hallmark might want to get the ratio below 1:1 to improve their long-term business viability. Okay. So the optimum that the oversmart person created is 1.1:1. Now what is it saying is for every $1 paid by the owner in equity share, we have taken $1.5 loan. Hence, let's write this. This could be a red flag that it has to pay more interest than dividends. Okay, what to write? What to write? Yeah, red flag to pay more interest than dividend. Okay, now you can just, okay, this is the formatting part which I hate the most, but still I do it every time. Okay, so let's come to this one right here, that is our own company. Ratios of this. Okay, okay. How much is the total liability? Just a second. Okay. Right here is with me the balance sheet of Beyond Milky Way. Okay, total liability comes to, how to calculate total liability? So total liability will be calculated by, oops, yeah, do we have total liabilities here? Nope. Non-current plus current will be our total liability. Okay, so and this is okay, okay. So 1756 275, 1756 275 divided by how much? Share capital plus reserves and surplus, that comes to total of 303. But what is this right here? Ungrouped equities and liabilities. These are also liabilities only. Okay, let's choose a much smarter way. That is, you can add 52 lakh plus 1869 289. Okay, 52 1 2 3 4 5 plus 1869 289 divided by how much? 29 53 8500. 29 53 8500. Total stockholders equity. Okay, that is capital account. Let's check if it gives us correct answer or not. 52 1 2 3 4 5 plus 186 9289, okay, equal to this divided by this figure right here. Okay, 0.239. Okay, just a second. Okay, I know one thing, that this amount should be added with the profit and loss account, that is also transferred as, that is retained earnings, that is 838708 plus 838708. Okay, and let's now calculate it. That is, total liability is 52 lakhs plus current liabilities. Do we have anything else that should not be here? Okay, provisions and outstanding expenses and advance rent. Okay, let's calculate the amount equal to 52 1 2 3 4 5 plus 1869289 equal to 29538 plus 838708 equal to this divided by this 0.23271. Okay, hence 0.23 or 0.23 is to 1. Okay, so as this is below the limit and there are more stockholders than more than the long-term loans, hence this is good sign to have more equity than debt. Okay, now the next in line is times interest earned ratio, which we'll study in the next lecture. Okay, good day.